Welcome back to The Dive. The U.S. inflation rate accelerates to a 40-year high of 7.5%. And our guest today is here to share his insights about the January CPI, as well as price changes, the commodity that he thinks has the most potential in the current market, oil prices, silver, and gold. He is a partner and portfolio manager at Crescat Capital. Tavi Costa is joining us today. But before we bring you Tavi's interview, just a quick reminder to go ahead and smash that subscribe button so we can keep making you these videos. Hey Tavi, welcome back to The Dive.
Thanks for having me again.
Thank you so much for joining us. Okay, so let's start with the U.S. Consumer Price Index. According to the BLS, CPI surged to over 7.5% year over year. Do you think we're going to start to see an increasingly aggressive Federal Reserve?
I actually think, I've always thought that the Federal Reserve is trapped, first and foremost, but I think we're getting close to a situation where we're at peak tightening for the Fed, meaning I think that the markets is starting to react to financial conditions, is starting to tighten in many ways. One of the things that I'm concerned about is the profitability of companies in general, which is financial conditions tend to lead with the 6 months lead here, profitability for companies in the US, especially the S&P 500 members. And so I think we're at peak earnings. I think we're at peak profit margins in general. I think we're going to see a decline of that. Some of that is squeezed by wages and salaries. What you just said in regards to materials and the cost of things in general have been going up. And so it's going to be squeezing the profitability of companies. And I think it's going to be very difficult to severely tighten financial conditions going forward. I think we're seeing the back end of the curve, the 10-year yields is starting to rise, as we discussed in other interviews here with you guys. That was a risk, given the fact that we're seeing a major amount of issuances of treasuries. But I think that narrative of tightening is getting close to its peak. And I think we're going to see the other side of it. And that's why I think precious metals are moving already ahead of that.
So we saw one of your recent tweets about the price changes since January 2021, with coffee being the highest, followed by natural gas, and then crude oil. Some argue that the numbers feel off and real inflation is much higher. Could you shed some light on this for us?
Sure. I do think inflation is at double digits. And if you're a company and you're not growing at double digits, you're just not keeping up with inflation at all. And there is this perception by the markets and by market participants in general that inflation is actually positive for companies. And that is true for a very small percentage of them. But the majority of companies actually get squeezed by wages and salaries, energy prices going higher, material costs that are not capable of passing that on to the consumer. And so I think that that's going to be the majority of companies here. We are in a regime change for a macro environment in regards to higher costs of capital that is also going to be squeezing margins as well. So a lot of things to think about here when it comes to that. I don't think we've ever seen the environment we have today with inflation, the amount of debt that we have, and at the same time, high valuations. We've seen separate parts of those in the past, but we've never seen those three happening in tandem. So I'm quite worried that inflation is here to stay. And I think that we're going to have to reassess our views about what the leadership of the market is going to look like, given the fact that those factors are going to be changing.
Mm-hmm. Which commodity do you think offers the most potential upside in this environment?
Well, if you think that inflation is here to stay and you think we're basically near peak tightening for the Federal Reserve, because we all know the Fed will try to tighten as much as they can, but it's going to compel them, the fact that we have the amount of leverage on the government side, the valuations don't allow the Federal Reserve to take rates anywhere that would sustainably or be capable of reducing inflation rates, which would be double digits like we saw back in the 70s. So it's creating a setup that is extremely, extremely bullish for tangible assets. And the question is, which ones are the ones that are going to perform the best? I think all of them will. Personally, I think it's time to be allocating capital towards that and removing your allocation into financial assets that are extremely overvalued right now. My favorite, obviously, is silver. I still think silver fits into the historically undervalued kind of asset that is part of the green revolution. It's an inflationary asset. It's a monetary metal. And then you follow along with gold, because gold still is one way to protect yourself against this reckless amount of fiscal and monetary stimulus we've been seeing. And so all those parts will fit into the gold and silver side. Now, I'm extremely bullish on agricultural commodities. I think there's a very high risk that we're going to see food crisis that will still in a domino effect. We saw nat gas prices going up. We saw lumber, oil prices, ammonia prices, and then food prices begin to rise along with agricultural commodities. And I think there's even opportunity to be long cattle futures and things like that. So everything is going to be higher 5 years from now, in my opinion. And so you're looking at what are things that haven't moved yet. And I think agricultural commodities have just begun to start that upside move. But along with copper is another one that has been in a consolidation period for some time as well. And I think we'll continue to go higher, not lower. So I've been long a basket of commodities. And personally, I think silver is the cheapest. But I like all sorts of commodities, as I just said, and I think all of them have a lot of room to go much higher from here.
So if we look at the fundamentals of silver, we can see that the demand for silver has surpassed 1 billion ounces for the first time since 2015. Yeah. Do you think that this kind of demand is sustainable long term?
I think the demand is going to be much higher than that. I think the demand is going to be linked to a lot of the transition to the green energy we're going to see. I think there's going to be a lot of transition to this idea of the improvement of international reserves by central banks in general will drive big market participants to hoard things like silver and gold. And so I think that the demand side, we've been seeing a lot of it in an industrial side, but not so much on the hoarding of as a monetary metal. And I think that's yet to come. And that's the biggest wave of silver is through that. It's not so much on the industrial side. Industrial side should be the cherry on top. And so I think there's a lot more to go here. And that's why it becomes an explosive asset when we have gold moving and we have the miners going up. We're going to see, in my opinion, silver explosively move higher from here. And so, look, I am extremely bullish on this. I think that producers are starting to get squeezed on their margins, just like any other company here. And they might even have to rethink about how much they can produce going forward. So it's going to create even higher and bigger supply constraints that we've had. And so I'm quite concerned about, I think you want to own not only tangible assets, but you want to find ways of owning something that has leverage to the metal price. And in my view, the best way to do that is to find very high quality exploration assets, because you're owning basically the metal in the ground, and the metal in the ground has much higher leverage than the metal itself. And so obviously you want to own the high quality stuff, because if it's not high quality, you have zero leverage to anything. And so really that's, for me, that's where the game is for the following years, is owning, it's being part of this discovery process we're going to see in the years ahead of metals, and that discovery process, we would like to be as well positioned as we can, and participating in the biggest amounts of investments we can in that space.
Mm-hmm. Are there any gold names that you like in the space right now?
Oh, I like a lot. We own over 80 companies in our portfolio, but I have a lot of companies that I think are well positioned in that camp. And by the way, they're all very small companies. Some of them are actually nano caps types of companies, and they're just exactly what we would like to be, because we want to own 20% of those companies, as much as 20%, and then write it up as they do well. So a few of them would be SK Mining, Bell Copper is a new copper discovery we think they're onto. BCM Resources is another one. In the gold space, there Labrador Gold is a great one, right by Newfound Gold, which was a company we invested pre-IPO. Snowline Gold is one of our core positions. We think they're onto many discoveries in their projects, in their properties. Eloro Resources is probably one of the largest silver discoveries of our lifetimes here. So there's no shortage of names.
Yeah, there's a lot of good ones out there. Yeah, and gold prices have remained resilient in recent weeks despite the face of broad market volatility. Do you think, despite the challenging macro backdrop, do you think investment flows will start to be directed more into gold then?
I do. I think there's a lot of investors concerned about gold and precious metals in a time when markets are kind of in a turmoil right now. And I'm much more concerned about things that are over allocated than things that are under allocated historically. And so gold is certainly in that camp. Large capital allocators have forgotten about gold, silver, and the miners, but they're becoming fundamentally stronger. The thesis behind all those types of investments is getting much more attractive over time. And so I think we're going to see major changes in the dynamic of capital flows into natural resources continue. I think we saw some of that in 2021. That growth to value transition is all falling into that. Technology are all long duration assets that are, in my opinion, extremely overvalued in this new macro regime change here, where we're going to see cost of capital rising and making it even more difficult to justify high multiples. And so you want to own things that are cheap and you want to own value. And I think you want to own profitability, companies that are able to pass on to the consumer, for instance, and have that pricing power and not get squeezed on margins. And I think some of them can be exploration assets and other things. But there's a lot of commodity companies that will have that pricing power. And so I'm very bullish on those.
Okay, very good. Okay, so let's move on and talk about oil here. President Joe Biden has issued a warning that U.S. citizens should leave Ukraine immediately as tensions with Russia over its military activity continue to intensify. Do you think the ongoing geopolitical tension will have an overall impact on oil prices?
I do, and I think this is, there was a paper from the IMF, I believe, saying the opposite, saying that deglobalization is actually something that is not necessarily inflationary. I'm on the other camp. Deglobalization is extremely inflationary, and the whole reason why we haven't seen a secular trend of inflation, in my opinion, aside from other factors, it has been the globalization side of it. And now we're seeing the opposite of it. And so countries that have those natural resources are going to start showing their strength. I think Brazil is well positioned for the following years. Perhaps it does have important elections coming up, but I think there are countries that have those natural resources are going to become more and more strategic. Oil certainly is one of them. The U.S. and a lot of developed economies are pushing towards the green agenda and forgetting about how to develop and explore and produce very important and vital for the economy types of commodities such as oil. And so we're seeing more developing economies is starting to step up and starting to perhaps develop projects in this space. And so there are quite investments that we are involved with that we think are going to be basically funding a lot of the natural resources the world needs for the following years. And so I think there are, I think the more and more oil is going to be a macro asset that is so strategic that it will cause a lot of geopolitical issues. And so we own a lot of oil, we own a lot of nat gas, we own a lot of exploration and production companies in the space. We think this is very different in 08. Just looking at the capex, aggregate capex of the overall industry relative to what we saw back in 08, for instance, it's absurdly different. countries like China that are, if you look at oil prices in Chinese yuan, for instance, it's getting extremely expensive for those countries that are large importers of those natural resources. And so you have to start thinking about which ones are going to be impacted negatively and the ones that are going to be impacted more positively according to this. India and China might actually have issues going forward. And so we are starting to think about more in a global sense, what are the ones that are going to be really well positioned for the following years if we think we are in a commodities bull market for the next 5 to 10 years or so.
Mm-hmm. Yeah, definitely a lot to think about here. Okay, so Tavi, I wanted to ask you one more thing before we let you go here. Last week, Peloton held a virtual all-hands meeting that was meant to introduce its new CEO, Barry McCarthy. But it ended early as laid-off employees crashed it. Do you think we'll see more pandemic darlings shaken down over the next few months?
Yes, I think we've been in an environment where everyone is just so intelligent, and in a bull market, it's just exactly how that works. And the speculative environment we're in, it really resembles the tech bubble times. The difference is that on top of that, we have the government debt problem and inflation and cost of capital beginning to rise and starting to really challenge the multiples we're seeing in companies like Peloton was 2 years ago. And so there are a lot of companies in that camp that I don't think are going to come back. And the investors that have been trained to be buying the dip every time the equity markets corrects 10, 15% are probably going to start having issues. The meme stocks are down significantly. You got Chinese stocks never came back to their highs from February. Software companies having issues. Software is, has been the leader of the market of the last 5 years or so. I'm not sure that's going to be the case for the next 5 years. I think that is not an environment where you want to be owning a lot of software related companies right now. Those are very high duration types or long duration types of assets. And I'm not sure that that's going to be what's going to be favoring the market here if we do see cost of capital continuing to rise. Cost of capital is it's basically at its highest level since 2008. The difference is that 2008, we didn't have corporate debt at the same levels we have today. It's much higher than even the tech bubble as well. So we've got three forces happening at the same time. It's debt, valuation, and inflation. They're happening, and they're. I think it's really going to constrain policy making in general, and it's going to be extremely positive for tangible assets relative to financial assets over time. Those are all long-term transitions, and they will take a long time to materialize. But I do think that that's already happening, and we'll continue to see that going forward.
Okay, well, that's all we have for today. So thank you so much for joining us today, Tavi. It's been a pleasure to talk to you.
My pleasure. Thanks for having me.
Thanks so much for tuning in today. We'll be back again tomorrow with the latest news and updates. So be sure to hit that notification bell before you leave.